A brief history lesson on recession. Let's go back a millennia ago. People of Britain have been using bronze to make jewelry and tools, and even used it as currency for trade. Everything changed when the value of bronze declined, thus generating social upheavals and economic crisis. This is widely known as recession in today's time. Hey guys and gals, welcome to another episode of Financial Ventures. If you like the content, be sure to like the video, subscribe to our channel, and hit the notification bell for more informative videos about finances. Remember, all you need is financial ventures in your life's adventure. What a great way to start talking about the economic events and phenomena that may affect our lives in one way or another, other than tackling the biggest and most obvious of them all, recession. Recession, as what people experience and learn, is a decline in economic activity that can last for months or even years. One can say that a country is in recession if there's a negative gross domestic product, rising levels of unemployment, failing retail sales, and contracting measures of income. Can we avoid recession? The answer is no. It is, unfortunately, an unavoidable part of what we call the business cycle. Before fully diving into our topic today, let us make a quick comparison of what is the difference between a recession and a depression. They both have similar causes, but depression has a much worse overall impact. There is a greater rate of unemployment, steeper declines in GDP, and most of all, it takes years for the economy to recover once it enters a depression. To make it easier to understand, let's take a quick look at the Great Depression in 1929 through 1933 versus the Great Recession from 2007 to 2009. During the Great Depression, unemployment is at 25%, GDP is at 30%, and they didn't fully recover until the end of World War II, almost a decade later. But during the Great Recession, unemployment is at 10%, and it only lasted for 1.5 years. There are far greater lengths that only depression can go into. So, how does a recession happen? You can compare our economy to an ocean wave with its highs and lows. If it grows, we are at its peak and we call it economic growth. But it will decline and subside first before it can rise again, right? It's called an economic contraction once it goes down, or can also be called a downturn. Recessions usually happen in a business cycle, or simply put, as economic growth happens, asset values rise as well, thus enabling larger debt loads. You can watch our central bank roles video for an in-depth discussion of this one. At a certain point in time, growth contracts and may enter a recession. The question is, what causes a recession in the first place? Recessions are considered a phenomenon that was born out of sudden economic shock or an uncontrolled inflation rate. Nevertheless, we will provide you with a list of the common drivers of an economic recession. 1. A sudden economic shock. You might have heard of this for quite some time now, since this is a surprise problem that creates serious financial and economical damages. An example of this is when the COVID-19 outbreak happened. Economies were shut down worldwide. Another example was, in the 1970s, the Organization of the Petroleum Exporting Countries, or OPEC, cut off the supply of oil to the US without warning, thus creating an economic recession and endless lines at gas stations. 2. Excessive debt. Whether a private individual or business is taking on too much debt, the servicing may grow until they can't pay their bills anymore. Debt defaults and bankruptcies can capsize an economy too. 3. Emotions. Well, okay, not necessarily emotions, but more like an asset bubble. When investment decisions are made out of emotions and not logical reasoning, bad economic outcomes may follow. As an example, investors feel too optimistic during a strong economy, thus investing in a lot of shares and stocks out there. When inflation hits the stock market or real estate bubbles, panic selling can definitely pave the way for a recession. 4. Too much inflation. Excessive inflation is a bad thing since central banks will raise interest rates and therefore can cause depressed economic activity. Do you see the pattern here? Anything that is too much will definitely burst the country's economy. 5. If you heard about too much inflation, there's also too much deflation. Deflation can be even worse. Prices decline, then so do wages, which then further depresses economic activity. People and businesses stopped spending during deflation, and this undermines the economy. Sixth and last is technological change. What if AIs and robots take over the workforce? It will surely cause unemployment, thus contributing to economic recession and hard times. On a more serious note, a realistic example is where several professions became obsolete due to technological advances, thus leaving many people out of jobs and unable to contribute to the economy. How long does a recession last? And is it predictable? Can economists warn us months ahead before entering a recession? Usually, a recession lasts on average 11 months. This is a significant change since over the past 30 years, it can go and last for 21.6 months. Imagine the relief of improving the recession trend, right? So far, in the last 30 years, as mentioned, the US has gone through 4 recessions. One was the COVID-19 recession that only lasted for 2 months, making it the shortest recession recorded in history. 2. The Great Recession from December 2007 to June 2009, which was caused by the real estate market bubble, lasted for 18 months. The dot-com recession, which lasted from March 2001 to November 2001, was made possible by fallouts from tech bubble crash and a whole lot of accounting scandals at companies like Enron. To add, the attacks on the US on 9/11 contributed to the recession. And lastly, the Gulf War recession from July 1990 to March 1991 was again brought about by spiking oil prices during the first Gulf War. Recession affects people in all possible ways. You may lose your job, and it will be harder to find a job replacement too. If you are lucky, you get to keep your job, but you will definitely feel the effects of a pay and benefits cut. You will also find it troublesome to negotiate future pay raises. Investments in bonds, stocks, real estate, and any other assets will definitely lose money along the way too. It will then reduce one's savings and will affect a person's future plans, even retirement. Yes, you can also lose your house and other properties you own if you are unable to pay bills on time. This will create a ripple effect on banks to tighten their standards for mortgages and any other types of financing. It's hard to maintain a credit score in normal economic times. How much more during a recession when lenders want higher and better credit scores before lending you any amount of money? The thing is, a recession is always a part of a person's life. It can be a bit dramatic, but yes, it happens. The only thing you need to learn is that after every recession comes stronger economic growth. This is a good time for people to bring back what they lost and reinvest whatever they can to sustain and keep them growing. We thank you so much for listening. Comment down your thoughts below and suggest what else you want us to talk about. We hope to see you at the next one, and remember, it's better with financial ventures in your life's adventure.